Converge ICT Solutions Incorporated is a Philippine telecom company specializing in high-speed fiber optic broadband. Founded in 2007 by Dennis Oy, Converge operates the country's largest fiber-to-the-home network. It serves both residential and enterprise markets under brands like FiberX, postpaid plans, Beta Fiber, and Surf2 Sawa, prepaid. The company also bundles internet with content, such as Converge Vision IPTV, and is expanding into digital services. As of mid-2025, it has roughly 2.82 million residential subscribers, about 2.39 million postpaid for 130,000 prepaid. Converge went public in 2020 and is majority-owned, about 66%, by Comclark Network and Technology, Dennis Oy's holding. This structure gives Converge a strong capital base and leadership continuity. The company's strategy has evolved from pure telco into a tech co, emphasizing not only connectivity, but also enterprise cloud, AI, and digital solutions. It has invested heavily in network infrastructure, over 800,000 kilometers of fiber lines nationwide, and in-house platforms, like the Converge Experience Hub for customer service. Converge also benefits from related ventures. For example, its affiliate Reliance Broadcasting won a FTA TV broadcast license in 2024. In short, Converge aims to be the leading fiber broadband provider in the Philippines, with a growing emphasis on integrated digital offerings. Converge competes in the Philippine fixed broadband market, where its main peers are giant telcos PLDT or Smart and Globe Telecom. Unlike those incumbents, which rely heavily on wireless and mobile services, Converge focuses on fiber internet. This specialization has paid off. By mid-2023, Converge controlled over half of the country's fiber-to-home market, nearly 1.97 million FiberX subscribers for about 54% market share. By mid-2025, that lead had grown further due to robust subscriber additions. In first half 2025 alone, Converge added about 260,000 new residential subscribers, far outpacing its peers in the fiber segment. A key recent change is the Connectat Dong Pinoy Act, a law lapsed into effect August 2025, intended to open the telecom sector to more competition and infrastructure sharing. Analysts at First Metro Securities note this favors Converge's business model. The law targets reducing barriers, like fixed franchise requirements, which mostly impact mobile carriers, while fixed broadband players like Converge stand to benefit from leasing their excess network capacity to new players. In fact, First Metro rates Converge a buy with a 20.50 pesos target post-law. In summary, the broadband market is still growing and Converge Fiber Network gives it a dominant position. Competitive risks, such as new fiber entrants or alternate technologies, are tempered by excess demand and its leading infrastructure. Corporate rebranding from fiber to future. In mid-2025, Converge unveiled a new corporate identity to reflect its tech-driven strategy. A refreshed logo and mission now emphasize connectivity, intelligence, and experience, signaling a shift from a pure fiber image to broader digital services. CEO Dennis Oy and President Grace Oy highlight this as moving from just connecting people to providing broadband-enabled solutions. This is more than cosmetic. It frames Converge as an evolving technology company. Product strategy, Super FiberX, and bundling. Converge recently launched Super FiberX, a next-generation home broadband package. Super FiberX combines ultra-fast speeds, up to 400 megabits per second with Wi-Fi 6, bundled content like free access to Sky TV channels, and integration with the Converge Experience Hub platform. It's designed to capture growing demand for entertainment-integrated internet. Indeed, Converge reports that in Q2 2025, most FiberX subscriber growth came from Netflix bundles and Super FiberX packages. Converge COO Benazada notes that over years the company raised average speeds 11 times, from 35 megabits per second to 400 megabits per second, while slashing the cost per Mbps by over 90%. This aggressive product innovation helps Converge maintain its quality edge. Independent tests show it winning Ookla Speed Test Awards for fastest fixed network in Philippines, all major categories for first half 2025, reinforcing its brand reputation. Leadership and organizational changes. Converge has strengthened its management to support this transformation. In July 2025, veteran COO Jesus Boboy Romero retired, and Benjamin Azada, previously CCO and CRO, became the new CEO. Azada's track record includes around 15% revenue growth in 2024 and expanding the residential base to over 2.5 million. Converge also elevated Christine Renee Blabano, former deputy CFO, to chief risk officer, and Loris Esteban Tuason to corporate sustainability officer. The board welcomed Park Wong-gi, ex-CEO of Naver Cloud, in July 2025 to guide its push into enterprise cloud and AI. Overall, these moves reinforce Converge's tech co-pivot, ensuring operation and risk oversight, COO, CRO roles, while bringing in cloud and digital expertise. Converge financials remain strong and growing. In first half 2025, ending June 30th, consolidated revenues were 21.8 billion pesos, up 11.6% from 19.5 billion pesos a year earlier. Net income rose 12.4% to 5.9 billion pesos. EBITDA expanded 13.1% to 13.5 billion pesos, with an improved margin of 61.8%. Notably, residential segment revenue grew 10.4% to 18.4 billion pesos, driven by the 2.82 million subscriber base, while enterprise revenue, including wholesale, surged 18.3% to 3.4 billion pesos. Converge boasts industry-leading profitability. Return on invested capital was 17.7% in first half 2025, reflecting efficient use of capital. The balance sheet is sound. Net debt was modest, 11.7 billion in June 2025, with a low net debt or equity ratio around 0.2 times and a debt service coverage ratio of 3.3 times. Interest-bearing debt was largely covered by cash flow, and debt covenants were comfortably met. Capital expenditures totaled 4.2 billion pesos in the first half of 2025, funding network expansion. Importantly, Converge maintains ample liquidity. It even repaid some debt. Gross debt fell to 26.9 billion pesos in Q2 to reduce interest costs. Quarterly performance has also been robust. In Q2 2025, Converge earned 40 cents per share, up from 38 cents in Q2 2024. Also in Q1 2025, earnings per share was 41 cents versus 35 cents in the prior year. Consensus forecast had been for modest growth, and actual results slightly beat expectations. Year over year, Converge revenue growth for year 2024 was around 15%, 40.6 billion pesos versus 35.4 billion pesos in 2023. This sustained double-digit growth and improving margins highlight the company's strong execution. Converge has proactively bought back stock to bolster shareholder value. In May 2022, the company committed to repurchase 6.5 billion pesos of shares from its affiliate, Coherent Cloud Investments, Warburg Pincus, at 25 pesos per share. This large buyback reduced the founder's stake and increased public float. It was projected to lift return on equity by about 1.5 percentage points, or around 24%. In September 2022, Converge board approved a normal course issuer bid to buy up to 1.5 billion pesos of its own shares. The intent was to signal confidence in the stock's fundamental value and return capital to investors. These buybacks have shrunk the share count. There were roughly 7.25 billion shares outstanding by mid-2025, down from around 7.5 billion shares at IPO, and raised per share metrics. In August 2025, Converge disclosed further buyback transactions, executed under the approved program. By reducing shares, these repurchases should boost earnings per share and return on equity. Indeed, management has emphasized that buybacks are a sensible use of cash when the stock is undervalued. Overall, the buyback program tends to support the stock price by reducing supply and showing management confidence and enhance financial ratios. After a strong post-IPO rally in 2021 to 2022, Converge's share price declined in 2023 and in 2025. It traded as high as 20.15 pesos in mid-2025, but by late August 2025, it was near around 14 pesos per share, roughly 35% below its 52-week high. The drop partly reflects broad market weakness and some profit-taking after earlier gains. However, analysts still see upside. Independent consensus fair value models suggest the stock is undervalued. For example, one financial platform shows analysts' consensus price target around 21.70 pesos, implying around 35% upside from current levels. Sentiment has fluctuated with news flow. In early August 2025, Converge stock fell around 20% after its Q2 release, an example of knee-jerk selling. Brokers like First Metro have rated Converge as a buy based on industry reforms, while major telcos got only hold recommendations. In terms of valuation multiples, Converge trades at a low price-to-earnings ratio, which is around 8.9 times in August 2025. Given its growth profile, it also pays a healthy dividend, 43 cents per share in 2025, around 3% yield. Compared to peers, Converge is growing much faster. Its revenue compound annual growth rate is double-digit, while PLDT and Globe are mostly flat in fixed broadband. The market seems to be pricing Converge for moderate growth, a consensus of 10 to 12% revenue growth in 2025 after a guidance cut. If Converge can outpace that expectation, sentiment could improve. For long-term investors, the combination of solid fundamentals, growth, buybacks, and low multiples suggests attractive value. As with any investment, Converge faces risks. Competitive pressures could intensify. PLDT or Smart and Globe are expanding their fiber footprints, leveraging their huge mobile subscriber bases, and could engage in price promotions to win market share. Converge also has no mobile business, so it may face headwinds if many customers shift to mobile data or fixed wireless alternatives. Churn and saturation are a concern. Converge itself noted that customer churn in early 2025 was higher than anticipated, and it delayed some enterprise projects. These factors led management to cut full-year 2025 guidance to 10 to 12% revenue growth, down from around 15% prior. If churn persists or new offerings are slower to launch, growth could slip. Financially, Converge debt is moderate now, net debt to equity around 0.2 times. But continued large capex and potential additional debt for buybacks could pressure liquidity if revenue growth slows. Interest rates and peso depreciation affecting imported equipment costs are macro risks. Also, Converge industry depends on continual infrastructure build-out. Any delays in permits or fiber construction could constrain future subscriber gains. Regulatory changes bring uncertainty too. The Conectadong Pinoy Act, a potential boon, still requires implementing rules. If new policies, such spectrum reallocation or stricter service metrics, fall short of expectations, benefits may be muted. There's also the risk of foreign selling. Coherent Cloud's lockup expired in 2021, and some foreign hedge funds have traded the stock actively. Significant selling pressure from foreign investors, as happened in late 2022, could recur if global sentiment turns. Lastly, since the founding, the Oy family retained majority control. Minority shareholders have less influence. Any unexpected moves by the majority could affect valuation. Reasons to buy. Strong market leadership. Its subscriber base is expanding rapidly. 2.82 million homes as of first half 2025, and broadband demand remains robust in the Philippines. Consistent growth. Double-digit revenue growth, plus 12% year-on-year in first half of 2025, and net income up 12%. High profitability. EBITDA margin of around 62%, with industry-leading return on invested capital of around 17.7%. Product innovation. The company is executing its tech-focused strategy, launching new products, Superfiber X, winning Ookla's Top Speed Awards, and entering growth segments like cloud. Attractive valuation. Converge trades at under 9 times forward earnings, significantly below its 30 to 55% upside to consensus targets. Shareholder-friendly actions. Ongoing share buybacks and 3% dividend yield boost total returns. Regulatory tailwinds. Connect Tadong Pinoy Act likely to favor fixed broadband players like Converge. Reasons to hold Converge. Solid fundamentals, low leverage, net debt to equity ratio of around 0.2 times, and healthy free cash flow. Reliable dividends. Offers stable of around 2.5 to 3% dividend yield. Long-term strategy. Transition to a tech co with growth in enterprise cloud, AI, and digital services is underway. Strong execution record. Proven ability to add subscribers quickly and manage costs efficiently. Waiting for catalysts. Investors may prefer to hold until growth guidance stabilizes or new products gain traction. Reasons to sell Converge. Slowing growth outlook. Management cut 2025 revenue guidance to 10 to 12% from around 15% due to higher churn and delayed enterprise projects. Competitive pressures. PLDT and Globe are aggressively expanding fiber and could spark price wars. Volatile sentiment. Shares dropped around 20% after Q2 2025 results despite solid earnings. Macro and regulatory risks. Rising interest rates, peso depreciation, or unexpected regulatory changes could weigh on margins. Concentration risk. No mobile business. Reliance on fixed broadband alone may limit growth compared to full-service telcos. Control by majority owners. Founders hold over 60% of shares, leaving minority investors with limited influence. In summary, Converge ICT is a leading fiber broadband provider with strong recent growth and a bold strategic pivot toward tech-driven services. Its financials are robust, supported by record subscriber additions and high margins. The company's share buyback program has boosted key metrics and signaled management confidence. While the stock is currently trading well below its highs, analysts see upside to the mid-20s pesos, and recent reforms may favor Converge's business model. Retail investors should weigh these positives against the risks of a cooling growth rate and intensifying competition. The decision to buy, hold, or sell depends on your outlook. If you're optimistic about broadband demand and Converge's execution, it could be a buy. If you're cautious about headwinds, it may be a hold at current levels. And if you fear stalled growth or market volatility, selling to lock in profits is a defensible strategy. If you found this video helpful, don't forget to like, share, and subscribe to the channel for more in-depth stock analysis and personal finance insights.